For most of us, our home is more than just a place to live. It's our single biggest financial asset. But as we get older, the tax rules around that asset can get, well, pretty complicated. So today, we're going to unpack the essential tax strategies that can help you protect that asset and really secure your financial future. So let's just start with this really crucial question. After decades of payments and appreciation, your home represents a huge store of wealth. But getting to that wealth, or heck, even just living in your home, that's where this tricky web of tax rules comes in. The choices you make right now can have a massive impact, turning that incredible asset into either a powerful tool for your retirement or an unexpected tax headache. But here's the good news. You have way more control than you might think. We're going to break down all that complicated tax code into 4 clear, powerful pillars. These are strategies that will help you make really informed decisions, whether you're thinking about selling, planning to stay put, or maybe looking to tap into your home's equity. So here's our game plan for today. First up, we'll look at the absolute cornerstone rule for selling your home completely tax-free. Then we'll get into some of the tax breaks you can get if you decide to age in place. After that, we are going to clear up the confusion and demystify the tax truth about reverse mortgages. And you're going to want to stick around for the last one, where we break down a major new tax deduction for seniors that could really change the whole game. All right, let's dive in. Okay, let's get right into our first pillar, which is truly the foundation for any homeowner thinking about selling. This is the big one, folks. It's called the Section 121 exclusion, and let me tell you, it is probably one of the most generous tax breaks you'll find anywhere in the tax code. Getting how this works is step 1 in protecting every dollar of profit you've earned. So here's the core rule. If you're a single filer, you can sell your main home and exclude up to $250,000 in profit from your income. Think about that. $250,000 of the money you made on your house, just gone. Wiped clean off your tax bill. This isn't a deduction. It's an exclusion, which is even better. It's like that profit never even existed in the eyes of the IRS. And if you're married and filing a joint tax return, well, it gets even better. That incredible benefit doubles to $500,000. For anyone who's lived in their home for years, maybe decades, and watched its values skyrocket, that is a massive financial windfall, and it can become the absolute bedrock of your retirement savings. Of course, there's always some fine print, right? To get this amazing tax break, you have to pass 2 key tests in the 5 years right before you sell. First is the ownership test. You have to have owned the home for at least 2 of those 5 years. Second is the use test. You have to have actually lived in it as your main home for at least 2 years. Now, look at the difference for joint filers. This is critical. Only one of you needs to meet the ownership test, but both of you have to meet the use test to get that full $500,000 exclusion. But life happens, and thankfully, the tax code has some built-in flexibility. There are really important exceptions for major life events. A surviving spouse gets a special 2-year window after their partner passes away to sell the house and still claim the full $500,000 exclusion. If you have to move for your health before you hit that 2-year mark, you can often get a partial, prorated break. And for seniors who move into a licensed care facility, the rules get even more relaxed. You only need to have lived in the home for 1 of the last 5 years to qualify. So we've talked about selling, but what if you want to stay put? For a lot of people, that's the dream. Well, that brings us to our second pillar, the tax breaks you can get for making your home safer so you can age in place. The tax code actually gives you incentives to make these modifications, and it all revolves around medical deductions. Okay, so here's the first hurdle you need to know about. If you itemize deductions on your tax return, you can deduct your medical expenses, but only the portion that's more than 7.5% of your adjusted gross income, or AGI. Just think of your AGI as your total income after a few specific deductions. So, for example, if your AGI is $60,000, you can only start deducting medical costs once they go over $4,500. So what kind of stuff qualifies? Well, this is a great list of examples. When you make changes to your home, mainly for medical reasons, the IRS lets you deduct the costs. And here's the key. For things like ramps, grab bars, and wider doorways, the IRS basically says these things are for your health, they don't really add to your home's resale value. And because of that, you get to deduct the entire cost as a medical expense, as long as you're over that AGI threshold. Now, what about a bigger project, something that does increase your home's value? Let's say installing an elevator or a special pool for hydrotherapy. Well, you can't deduct the whole cost in that case. The IRS gives you this simple little formula. Okay, so you take what you paid for it, let's say 20 grand for that pool, then you subtract how much it bumped up your home's value, say 12 grand. That difference, the 8,000 bucks, that's your deductible medical expense. All right, pillar number 3. This is a big one, and honestly, a topic that's got a lot of myths and confusion swirling around it. The tax side of a reverse mortgage. This is a tool that lets homeowners who are 62 or older turn some of their home equity into cash. But the big question for a lot of people is, how does the IRS treat that money? And that leads us to the million-dollar question, right? It's the first thing everyone wants to know. You're getting this cash, maybe as a lump sum or even a monthly payment that feels a lot like income. So, does Uncle Sam see it that way? Is it going to be on your tax bill at the end of the year? And the answer, thankfully, is a big, clear no. The IRS does not see the money you get from a reverse mortgage as income. It's officially classified as a loan advance. And this is huge because it means that money isn't going to push you into a higher tax bracket, and it generally won't mess with your Social Security or Medicare benefits either. Okay, but what about the interest? This is where it gets a little bit trickier. With your regular mortgage, it's pretty simple, right? You pay interest every month, and you can usually deduct it every year. But a reverse mortgage, it's a different animal. The interest just builds up over time, and you don't actually pay it until the loan is over. So the question is, can you ever deduct it? Okay, so to get this deduction, you have to jump through 2 pretty specific hoops. First, you can only deduct the interest after it's been actually paid, which usually happens in one big chunk when the house is sold. You can't deduct it year by year as it piles up. And second, and this one is the real kicker, the interest is only deductible if you use that money to buy, build, or substantially improve the home itself. If you use the cash for living expenses, travel, or medical bills, nope, that interest is not tax deductible. And now for our final pillar. Let's talk about major tax deductions. Tax laws are never set in stone, and it is crucial to stay on top of new benefits. To show you just how big a deal these changes can be, let's look at a hypothetical new law. Imagine a bill passes that creates a brand new deduction, one designed specifically to give tax relief to Americans aged 65 and older. A law like this could create something we'll call an enhanced senior deduction. Now, the magic word here is additional. This isn't replacing anything that already exists. It would stack right on top of the extra standard deduction that seniors already get. It's just a straight-up boost designed to shield more of your hard-earned money from federal income tax. And we're not talking about chump change here. In our example, this new law provides an extra $6,000 in deductions per person. So for a married couple where both spouses are 65 or older, boom, that's a combined new deduction of $12,000. That is a serious increase in how much income you can have before taxes even kick in. This table really puts the potential impact into perspective. Just look at these numbers. With a law like this, a single senior's standard deduction could jump from around $17,750 all the way to $23,750. And for a married couple, it could go from $35,500 up to a massive $47,500. A change like this would make taking the standard deduction an even bigger slam dunk for millions of seniors. And here is where it gets really powerful, especially when it comes to Social Security. Right now, for many people, a big chunk of their Social Security benefits can be taxed. But look at this example. The hypothetical new deduction of over $23,000 is larger than the average taxable benefit. For a lot of seniors, a deduction of this size could be enough to completely wipe out any federal income tax on their Social Security. I mean, completely. So, let's bring it all home. We've walked through these 4 big pillars of tax strategy, and you can see how they all connect, right? Whether you decide to sell your home, stay in it, or borrow against it, the tax code gives you specific tools to manage that asset. From that huge tax-free profit when you sell, to deductions for aging in place, to knowing that reverse mortgage money isn't income, each rule is a strategic option for you. The big takeaway here isn't just about memorizing rules. It's about seeing these rules as a set of tools in your financial toolkit. The home sale exclusion, medical deductions, the tax truth about reverse mortgages, and new senior deductions, these are powerful options. They can help you preserve your wealth, improve your cash flow, and just live more securely. So the real question now is, you've got the knowledge, what's your next move going to be? How are you going to build a personal strategy that works for you and your family?